Welcome back to the channel. Today, we're uncovering a shocking truth about investing that most people, and even many on Wall Street, don't want you to know. Imagine this. Owning a portfolio of 100 well-selected companies can actually be less risky than owning thousands. That's right. More isn't always better. University research has proven that after holding around 20 to 30 stocks, adding more doesn't significantly reduce risk. But there's a twist. If you choose your holdings carefully, the game changes entirely. In this video, we'll explore why quality-focused diversification beats sheer quantity and how you can apply this strategy for long-term growth while avoiding unnecessary risk. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the basics. Traditional advice tells us that diversification is the ultimate way to reduce investment risk. And it's true to an extent. Academic research consistently shows that adding more stocks initially reduces what's called unsystematic risk, the risk specific to individual companies. Studies from multiple universities demonstrate that a portfolio of 30 stocks eliminates roughly 95% of this type of risk. Add more 50, 100, even 5,000, and the reduction is negligible. The math is clear. Beyond 30 or so holdings, you're essentially getting no meaningful risk protection. Here's where most investors get it wrong. Blind diversification, buying everything you can, hoping winners outweigh losers, sounds safe, but it's actually a trap. Owning thousands of stocks means you automatically hold weak companies, over-leveraged firms, struggling retailers, dividend cutters, and businesses teetering on the edge of collapse. A broad index might include tech giants alongside companies bleeding cash or drowning in debt. You might think more stocks equal safer investing, but in reality, you're taking on hidden risks you can't control. Now imagine flipping the script. What if you could keep your portfolio at a manageable 100 holdings, but only include companies that meet strict financial criteria? Suddenly, you're not just diversifying, you're diversifying intelligently. This is no random approach. Every position would have to pass rigorous filters, at least 10 consecutive years of dividend growth, strong cash flow relative to debt, high return on equity, and sustainable payout ratios. Most public companies fail these standards. You're left with survivors, businesses proven to generate consistent profits over a decade. This is what I call quality diversification versus diversification theater. The math backs it up. Harry Markowitz's modern portfolio theory demonstrated that combining assets with imperfectly correlated returns reduces portfolio risk. But later research refined this. You don't need hundreds of names to capture the benefits. Studies from Mayer Statin show that 30 to 40 carefully selected stocks provide almost all the risk reduction you could achieve. Burton Mackey's analysis in A Random Walk Down Wall Street confirms that 32 randomly chosen stocks capture 95% of diversification benefits. Increasing to 500 barely changes the risk profile. Breaking it down further, wealth tracking studies reveal that doubling holdings from 10 to 20 reduces uncertainty by 25%, and increasing from 10 to 50 cuts risk by over 50%. Beyond 50, adding more stocks yields trivial benefits. But when you layer in quality screening, something remarkable happens. Portfolios made up of fundamentally strong firms, profitable, cash-generating, dividend-sustaining, experience lower maximum drawdowns, even with fewer names. Why? Because you've already excluded companies most likely to cause permanent losses. Real-world examples reinforce this. Take SCHD, the Schwab U.S. Dividend Equity ETF. It holds roughly 100 companies that pass strict screens, 10 consecutive years of dividend increases, strong cash flow to debt ratios, returns exceeding industry medians, and sustainable dividend policies. It's rebalanced quarterly and reconstituted annually. The results? A 10-year annualized return of 11.5%, current yield of 3.8%, and maximum drawdowns smaller than broader indices, all while holding only a fraction of the companies in a total market fund. This demonstrates the power of quality-focused diversification. Firms with strong balance sheets and sustainable dividends fall less in market corrections than speculative businesses. By selecting holdings that meet strict criteria, you build defensive buffers that blind numerical diversification can't provide. Another critical factor, behavioral finance. Investors who understand their holdings are less likely to panic sell during downturns. That persistence during volatility compounds into massive long-term outperformance. And here's the kicker. Simple ETFs like SCHD with roughly 100 holdings and a 0.06% expense ratio have outperformed 70% of actively managed funds charging 1% or more over the past decade. The math doesn't lie. Concentration and quality beats more is better strategies every time. Why does Wall Street resist this message? It's simple. Asset managers profit from complexity. More stocks justify higher fees, give the illusion of diversification, and obscure poor quality holdings. Actively managed funds with hundreds of positions often underperform concentrated funds with 20 to 40 high-quality names. Meanwhile, rules-based ETFs with about 100 screened companies consistently outperform the bulk of their competitors. The system is elegant. Own firms with proven track records, strong cash flow, increasing dividends, and solid profitability. Rebalance quarterly, repeat forever. No stock picking, no guessing, no market timing. Just systematic quality screening, combined with mathematical diversification. The result? A portfolio that reduces risk, participates in upside growth, and avoids the stress of thousands of unknown companies. Rebalancing adds another layer of advantage. By trimming winners that exceed optimal weights and adding to underweighted positions that meet criteria, you're mechanically buying low and selling high. Studies show this can add 1 to 2% annualized return over decades. A $100,000 investment could grow to $432,000 instead of $156,000 simply from disciplined rebalancing. That's an extra $276,000 purely from following a systematic process. In short, fewer holdings with higher quality consistently outperform countless holdings with no screening. Mathematics proves that 20 to 30 stocks eliminate most diversifiable risk. Beyond this, quality selection around 100 holdings, companies with 10 years of dividend growth, strong cash flow, and consistent profitability provides both risk reduction and downside protection. It's simpler, more understandable, and demonstrably effective. To wrap up, owning thousands of stocks doesn't automatically make your portfolio safer. True diversification isn't about quantity, it's about quality plus quantity. Research, real-world ETFs like SCHD, and behavioral finance studies all point to the same conclusion. A manageable, quality-screened portfolio of around 100 companies delivers maximum risk reduction, consistent returns, and peace of mind. You understand what you own, avoid companies likely to fail, and benefit from systematic rebalancing. In the long run, concentrated quality beats blind diversification every time. Focus on solid businesses, let the mathematics work, and watch your portfolio grow smarter, safer, and stronger. Drop a comment below if you're ready to embrace quality over quantity, because this is how concentration wins. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.